Welcome to Advisor Wars, the podcast where we take a critical look at the key issues facing the financial advisor profession. I am Bob Huebscher, and joining me as co-host is Joe Halpern, Managing Partner and Chief Investment Officer of Obsidian CIO. I was the founder of Advisor Perspectives and led it as CEO until 2024. This is the 9th episode of Advisor Wars and the third installment in our series examining the role of tax planning in the advisory profession. Our topic today is Section 351 exchange ETFs and related tax-efficient diversification strategies. And with us is Meb Faber, who is a co-founder and the Chief Investment Officer of Cambria Investment Management, and he's also the author of multiple books about investing. And at the end of this podcast, he's going to tell us about his newest book, which comes out on July 4th. So, Meb, I'm going to have you start off by telling us how you came to co-found Cambria and what is its focus.
Well, as of today, we're an ETF issuer. We have 20 funds, over 100,000 investors all around the world, about $4 billion in assets. But that's not the way it began, like you mentioned. And actually, Bob, we hit a 20-year anniversary this year, which feels crazy. It feels like just yesterday. I was moving down here to Manhattan Beach in Los Angeles to start this company. And like most of us in our 20s, I said, hey, I'm going to give this a year, maybe two, see how long this lasts. Worst case scenario, I live at the beach in Los Angeles, which I assumed I would hate, by the way, but have now inherited a wife and a child and a house and got all sorts of California roots now. But definitely like most entrepreneurs, you have to have a little bit of that naive optimism to believe that you'll be the one that can do it. Whereas most of us, come to it knowing that most startups fail. And as we tell most people in life, but also in investing, survival is the most important thing. Getting, with your investing portfolio, but also with companies, we're trying to build this company for the long run and survive these market cycles, which, by the way, for the last 17 years, man, has just been a romping, stomping bull here in the United States. We're near all-time highs, and so everyone listening probably fat and happy and let the good times roll.
Yeah, so let's start off, Meb, by discussing how ETFs provide tax efficiency for non-sheltered accounts. What are the key mechanisms behind ETF tax efficiency, and how does the ETF structure differ from that of a mutual fund?
ETFs, we're borrowing a phrase from Mark Andreessen, where we say ETFs are eating the asset management industry. And if you look at sort of these flows in the every day, every week, month, year, moving into these ETFs, which on average are lower cost, but as you mentioned to me, the key feature being much more tax efficient than traditional vehicles, they really got their start 30 years ago. And part of this was an overlapping trend that began 50 years ago with Jack Bogle and Vanguard and Wells Fargo and others that were doing index investing. And index investing is not really the massive innovation that happened. I think a lot of people confuse this a little bit, but really the revolution was low cost investing. And in the modern age, active, passive, it can mean anything, but really this transition, particularly in the United States, and it's spreading around the world, of moving from investment funds that charge 1.5%, 2%. I mean, the average mutual fund is still 1.25% today, not dollar weighted, thankfully, because Vanguard is soaked up so much of the world's investments. But so you've had this trend from ETFs starting to take away assets from mutual funds. And part of that is this creation redemption feature where an ETF can rebalance a portfolio and defer those gains and not pass them on to the end shareholder, which is, if you include the management fee difference in a taxable account, this is probably worth just 1.5% or more per year, just on choosing a better structure, which is meaningful and adds up over time. We say to people often who spend all day long, hey, are stocks expensive? Are they cheap? What's the Fed doing? Should I buy gold? What about foreign stocks? And all this investment alpha they're on the search for. We often say the old boring alpha of fees and taxes is much easier and much simpler to be able to create some alpha there by just by choosing the right structure and right idea over the long term.
Meb, that's very helpful. And I know that the creation and redemption process is really the key to driving the tax efficiency of ETFs. But before we give ETFs a full-fledged endorsement, there are some disadvantages relative to mutual funds. And I want to make sure we hit on those, such as the bid-ask spreads and the disclosure of daily positions. What should investors be aware of in regards to those points of friction?
Well, I see the daily reveal positions as a positive, not a negative. I think a lot of people for many years a lot of managers would love to pretend that there's a velvet rope and they're doing something super sophisticated and secret. They have a very proprietary methodology. And then you see that what their returns are, you see what their positions are. You're like, wait, that's it? That's all you've been doing? So I actually see that as a benefit. But bid-ask spread and intraday liquidity to me is not a benefit, right? I think, being able to trade. And if you look at all the massive amounts of ETFs that have launched, there's more ETFs than stocks now over the past number of years. To me, those are not beneficial funds or structures. It's like going to the grocery store and going down the cereal aisle. There's just hundreds of choices, most of which that are not good for you. Stay away from those frosted flakes, y'all. And so, yeah, the trading costs, of course, add up. But we talk to people for the most part. When you're buying these funds and strategies and ideas, hopefully your holding period is measured in years and decades, not hours and days, like a lot of people today. And we will say to people that, particularly the advisors listening, I think this is a point that's often overlooked. You can almost always, I can't say always because it's an investing world, but call your desk. And if you're buying, say, more than 50,000 shares or $1 million, 50, 100, $500 million, you can almost always get in right at net asset value by the desk being able to do custom creations and redemption. So, but for those trading 10, 100 shares, be mindful of the bid ask and just don't wake up in the morning and YOLO in a market order at market open. That's the probably best advice. Use limit orders and be a little patient.
Well, let's discuss Section 351 exchange funds. Could you explain how those work, key benefits they offer to clients, and how they differ from traditional exchange fund structures under Section 721?
Yeah, this is great because we've been talking about this for a couple years now, and yet I'll go give a talk to a bunch of CFAs, which, should be the most well-educated and involved investors on the planet, CFPs, on and on. And I'll say, how many of y'all have heard of 351? And it's about 95% say they haven't still after 2 years. And the other 5% probably listen to my podcast, so they don't count. But 351 is interesting because it's been in the tax code for 100 years. It's actually been around for a really long time. But only recently did it find its sort of perfect spouse or partner with the ETF structure. And I'll tell you why it's also pretty interesting today is because there's a lot of people that look at the stock market, they look at the 17-year bull run and say, wow, it's been amazing, but I've 10x'd my money, or I've held NVIDIA and I've 50x'd or 100x'd my money. And I'm nervous because the market's expensive and I want to get out, but the tax man's going to kill me. So how does 351 help? Because there's not a lot of choices out there for people that have highly appreciated stock. Traditionally, it's just sell it, move on, pay the tax man and call it a day. Well, 351 originally originated when you're trying to form a new corporation. So think the three of us were, starting a new farming company 100 years ago. That's what everyone did 100 years ago. And, Joe's got some seed and Bob's got a tractor and I got a barn. You come together, you form a corporation. That's not a taxable event. Well, the modern interpretation is you can actually seed the launch of a new ETF with a bunch of stock or ETF positions and get the ETF back in return, and it's not a taxable event. We say somewhat reasonable comparison is something like a 1031 in real estate, where you've owned a building for 30 years, you want to roll it into a different building, and that's not a taxable event. There's a bunch of rules and regulations that go around this so that it's not a specifically doing this for tax reasons alone, which the regulators wouldn't like, and we can get into those in a minute. But I think this intent of, and by the way, listeners, it is not a tax wash that would be illegal. It is a tax deferral. And so if you want to get into the specifics, I can go down some of the rules and regulations. But in general, it's a way to think about, hey, how do I go from this highly concentrated portfolio or highly appreciated portfolio into something else that traditionally is usually a little more diversified or gives me a different exposure and the simplicity and rebalancing of an ETF.
Great. So, yeah, I do want to go into some of these specifics, maybe not all of them, but there are a few key issues. Can you talk about what's called the 25% rule and the 50% rule? And also, what are the limits on the types of assets or securities that can be fed into a Section 351 ETF?
Yeah, great. So we've done 4 of these already. Our 5th one being in mid-June and the 6th one being in the fall time. And the way that it works is let's say someone's listening to this and they're getting all hot and bothered. They're like, oh, baby, I got 10 million NVIDIA. This is the perfect solution. I've been trying to follow these exchange funds from Goldman and Eaton Vance, but they charge 2%. You got to hold it for 7 years, yada, yada. This sounds perfect. Well, hold on, pause. The biggest rule is the contributing portfolio, the top position can't be above 25%. So if you got 10 million NVIDIA, no good. You could do 2.5 million NVIDIA and 7.5 million something else. And the second rule, and this is a word salad, so I'll explain. Top 5 positions can't be above 50%. And so the reality is you need either 12 stocks or more, or, and this is a giant asterisk, ETFs or pass-through. So you could actually contribute 100% SPY or VTI or one of these funds that has hundreds of securities because it looks through the underlying holdings. Or you could do something like 2.5 million NVIDIA, 7.5 million SPY, etc. The contribution should broadly match what the fund is doing. So our fund, let's say we have a global stock fund. Well, you can't be contributing bonds or Bitcoin. You can't contribute private investments or derivatives or options. You can't contribute mutual funds. So really only liquid stocks and ETFs. We don't want your 3X MicroStrategy. We're not going to take a tiny microcap junior miner based in Utah. But really, does it fit the prospectus and idea that the fund is actually launching? And often we'll get 800 plus contributions. I mean, concentrated stocks, an obvious one. Direct indexing is another one. People trying to strategically rebalance away. So a good example would be, hey, I'm all in on U.S. investments and I want to move to a more global exposure. We see people doing that as well.
And one final point, and you touched on this briefly, but clients must invest in the ETF at the time it's seeded. Is that correct?
Yeah, so once it launches, it's just like any other ETF. Day 1, day 2, anyone can buy it. They can go to Schwab. Anyone can sell it. And if you did seed it, and let's say you contributed 20 positions, you'll get 20 different tax lots at Schwab related to the ETF. So you can kind of mix and match on how you want to hold those. You could theoretically sell them day 1 if you wanted to, or hold them for 10 years. But pick and choose, but they carry over from the contributions.
And what is the 7-year? You referenced the 7-year rule in answering on that last question.
So there's a close cousin that's also been around for decades called the exchange fund. And the exchange fund, traditionally you got to be accredited. It's a private fund. You contribute assets. You got to hold it for 7 years. You got to put 20% and a bunch of weird alternatives. The contribution ends up being just what other people contributed. So a lot of times if you have something like NVIDIA, they won't take it because most people only have NVIDIA and they want to diversify. They can't rebalance the portfolio similar to how an ETF can post contribution because they don't have the traditional creation redemption mechanism. But the bigger problem is traditionally it's the world of high fees. So Goldman or Eaton Vance probably charging you 1%, 1.5%. There's probably setup fees, on and on, versus our, last launch and next launch is 0.25%. And that's it. There's no other embedded or hidden fees. So quite a bit cheaper. But again, there's some benefits to that structure for certain people. And certain people, a 7-year hold may be a good thing, keeps them from doing dumb stuff otherwise.
And so does the 7-year rule not apply to the 351? In other words, they move their security into the 351 exchange and then immediately they could sell?
You could. And remember, the cost basis on the 351 will match. So if you contributed NVIDIA, you bought at $1, and Pfizer that you have no gain on, and on, when you get the ETF back, it'll have the same cost basis. So if you sell the portion that related to the NVIDIA, well, you're paying capital gains on when you bought NVIDIA 10 years ago or whatever it was. If you sell the Pfizer, you're paying no capital gains because you didn't have any. So it just matches the portfolio of what you contributed. Theoretically, you could sell it day one. In reality, the people contributing, because they usually have a bunch of embedded gains, they usually hold them for a fairly long period of time, right? And it's also, if you put on your academic hat, it's kind of interesting because theoretically, one of the reasons that market cap indexes are predisposed to bubble periods like the late 90s or the 80s in Japan is people that do have large embedded capital gains don't want to sell because of that reason. They would love to rotate into other things. Theoretically, in an academic kind of stance, this makes markets more robust and healthy as it allows quite a bit more liquidity and ability to move positions out of these highly appreciated, expensive names into other parts of the economy and the stock market.
So a key benefit of a Section 351 ETF is diversification. On day one, when it's seeded, I imagine it doesn't look exactly like an index fund, or whether that's a U.S. or a global index fund. How long does it take before the holdings actually do approach an index fund?
So 2 comments. All 20 of our funds are active ETFs. Now, that's sort of a confusing label in 2026 because we essentially run in-house index funds. So we're quant-based, we're rules-based, everything we do, you could essentially call them index funds. The reason we don't call them index funds and publish the indexes is the dirty secret of indexing, and you're kind of seeing this real time with SpaceX and some of these inclusions and how this is working with the S&P 500 and the NASDAQ, is the indexes get front run, and that's a very real cost to investors. So if you hand someone your playbook and say, here's what we're going to buy, here's what we're going to sell, guess what? The really smart hedge fund and high frequency investors will go out and buy the things coming in, sell the things coming out. And in some cases, the academics show that's a cost of maybe 10, 20, 50 basis point. And in some indexes, it's a multiple percentage point cost per year. So we do it in-house and it's active. So in general, the positions broadly match the mandate of what we're trying to do. So if you look at our next fund, is a global stock fund. It's meant to reflect the top 500 companies around the world, not market cap weighted. So trending towards something like a equal weight, depending on what is contributed, and we control that. We often tell people we tend to be extremely conservative on tax rules and regulations. But I like to say that we believe in the first week, you're going to have probably a 95% correlation in beta to the fund, which is essentially for most people almost nearly identical. And it's the football analogy for anyone listening. In my mind, it's kind of like, hey, you're starting at the 10-yard line, you're moving to the 9, to the 8, to the 7, to the 6. But we also tell people to be conservative. Hey, this may not look what you think it may look like in your mind for a year, 12 months, but we're definitely not going to, there's certain people who are much more creative with the rules, and they'll turn the portfolio over on the first day. And to me, that looks like you're doing it for only tax reasons, which I don't want, people to be doing or to be thinking about it for that reason alone.
And you said that your expense ratio is 0.25%. Are there any other fees that a potential client would have to think about?
No. And on top of that, it's pretty cool because all of our ETFs do short lending. And so we return all the lending revenue that we would receive to the shareholders. In some cases, that may only be 5, 10, 20 basis points. But we've had ETFs in the past where the short lending revenue is larger than the management fee, meaning you have a negative management fee, which means you're getting paid to own the fund, which is pretty cool. For this, but we can't claim a certain amount. We can't claim, what it's going to be because it varies over time based on demand for short lending, shorting, as well as from other funds and just different points in the cycle. Obviously, you're wherever you have your brokerage account. If you sell the fund, you'll pay normal commissions or none or whatever it may be at Schwab, et cetera.
And how should one, like an RIA or any investor, evaluate these Section 351 funds relative to a traditional exchange fund?
I think, like anything, you should be cautious, right? People with money, the good news is they tend to, depending on where you are in the market cycle and, the thematics and all these crazy funds launching, maybe not that cautious, but hey, read the prospectus, do your due diligence, talk to the managers. The good news is we've gone from a couple years ago, nobody have heard of these, to now there's been over 20 billion. These 351s are happening all the time. We've done, after this launch, it'll be, I think, close to $1 billion, if not over. And, it's more of a rinse, repeat, a fair amount of, people being able to look at it and say, okay, this is Schwab, by the way, has an entire department that does 351. They love it. You're seeing a little more incumbent interest. I think it'll hit the mainstream this year. Now, the good news, the bad news, depending on who's listening, some of the traditional incumbents and some of the traditional plumbing channels can't do it or won't do it for various reasons. Which is a huge opportunity for independent advisors, huge opportunity for individuals. We've seen a huge adoption, particularly from family offices. They tend to be smart money and very tax focused, as well as some others. So I think you'll see a little more mainstream this year. But we're one of the few doing an open syndication. Most asset managers are only doing their own clients, and for good reason, because it's a bunch of work. Whereas others like us are opening it up to financial advisors and investors. We're trying to democratize, make it available to anyone. Whereas the exchange fund, by the way, is only available to accredited investors.
And what clients' situations does it maybe not make sense to use this strategy?
Well, there's been a revolution. I was at a tax conference last week in Seattle, and there's a revolution going on in tax management, which I think is great, in ideas. One of the challenges, I think, for a lot of people is, for example, if you're a young person, you may want to be tax gain harvesting. And people are like, wait, what are you talking about? And say, well, look, your tax rate is so low or zero or whatever it may be that you actually go ahead and book some of those gains. So it doesn't make sense to try to defer them to later when you're going to be a higher tax bracket or later. So I think just thinking in general about your situation, what you want to do, where you want to be 3, 5, 10 years from now, I think is thoughtful. But in general, there's academic research, pages and pages and hundreds of studies that concentrated stock ownership on average is a horrible idea and it underperforms the market. Now, everyone who has concentrated stocks says, yeah, but that's not me because I got rich owning this. Like I know this company, I know this stock. And I always point to and say, like, yeah, but people who used to own Cisco and GE and Enron and on would say the same thing, right? Nobody feels like the way they got rich is the way that, they want to diversify at some point. So there's a number of people. But it also doesn't have to be all or nothing. So many people in our investing world love to think in binary terms. Do I sell it all? Do I buy it? We'll say, well, maybe sell a quarter of it. Maybe sell a third or half and move on and do something else in 6 months from now. So I think it's very personalized, of course, but it could be a good tool for people that have some of these struggles.
I believe you spoke at Basis Northwest, which was produced by Brent Sullivan, who was the previous guest on this podcast. How what are the best practices for RIAs in terms of explaining the Section 351 ETFs to clients without overwhelming them?
Well, the good news is if you go to our Cambria Funds website, we have a 351 tab. It's got videos and cartoons and PDFs. I think with anything, with clients, the advisor first has to get educated and feel comfortable. Second is there's enough prior art now. I mentioned there's been a bunch of these so far. There's been billion-dollar ones, Goldman's done them, on and on. And so just being thoughtful, and we've seen for the last 4 that we've done, some advisors that say, hey, look, I'm going to do like $1 million or $5 million. I want to understand the process. Maybe I'll do it with my own money, or I'll do it with one client. And then the next one, they'll do it with 30 or 50 or 100 million, right? So I want to understand how it works before I just cannonball into the pool. So we've certainly seen a little bit of that. For those that have been historical real estate investors, I think it's not quite the exact analogy, but 1031 in real estate is a good, useful comparison to kind of compare, hey, this is how this works. Here's why we're doing this. It's a deferral. It's a diversifier. It's to try to make things a little smoother and less concentrated. And I think people understand that. I think particularly in this point in the cycle, this feeling feels very risky, where you have a lot of your net worth in one stock or 10 stocks that have gone up so much. I think a lot of people start to get that. And hopefully the advisors have been preaching some of the good message for years, educating them ahead of time too.
We will put a link to your website in the notes that accompany this podcast, as well as a link to your podcast that you mentioned earlier. What are the most common client objections, and how do you address them?
Ignoring the sort of education component, I think the biggest struggle is the very specific use case where someone's like, hey, I'm a SpaceX employee. I got 100 million SpaceX and I got nothing else. I say, God bless you. God bless you. Good for you. I think part of it too, though, is it doesn't have to be just one decision. So, for example, chatting with the basis crew in the Pacific Northwest was such a great conference because, look, there's a ton of great ideas. There's been a big adoption for long short direct indexing, which is kind of like a first or second cousin to 351 exchange funds. There's all these solutions, and you don't have to pick just one. And you can even pick one where you say, look, you can sell 10 or 20%, pay the gains, move on with your life. And there's all sorts of ideas with borrowing against the portfolio, collars, forwards, to manage these type of investments over time, and donating shares to donor advised funds, foundations, charity, church. And I said my favorite one, I was the last fireside chat at this conference. And I said, you guys, we've done 2 days, bell to bell, talking about taxes. Everyone's brains fired. But I said, you guys have just forgotten about the best way historically to reduce capital gains exposure. And no one's mentioned it. I can't believe it. And everyone kind of leaned forward, say, what's he going to say? I said, a nice big fat bear market, right?
Yeah.
You let the market cure this problem for you. And I used to joke with my mom about this. She owned a bunch of GE she'd owned for 10, 20, 30, 40 years. And she said, I can't sell it. The tax man's going to kill me. I said, well, sure enough, eventually the market's going to solve that for you. And this thing's going to go down 50% and you won't have to worry about taxes anymore. Now, the problem is you'll have half as much money. So too bad. So look, I think there's a lot of solutions that are bespoke and particular to a single situation, but take a moment, say thank you, say, wow, I'm blessed. The good news is you have capital gains. a lot of people don't have that problem.
Yeah, that's a great perspective. I think you referenced earlier $20 billion over the last couple of years have moved into Section 351 funds. That's obviously helping investors diversify concentrated positions. Is there any off-label use here, or it really is a product for? Yeah, go ahead.
It had its origins really in the mutual fund to ETF conversions. So you saw people like Dimensional who had 200 billion in conversions from mutual funds to ETFs because they were like, here's the sad reality of mutual funds. Every year at the end of the year, come October, November, you'll get this article by Morningstar talking about these mutual funds that are distributing 5, 10, 20% of assets is capital gains. You could have bought the fund, you could have a loss, and all of a sudden they're saying, oh, here you go. And it's just a terrible structure that's, a relic from a long distant past. And, if you own it in a tax deferred, that's different, but a lot of people don't. And they've owned these for a long time, but they're stuck. And so then you have this doom loop in some cases where there's withdrawals and they have to sell, and then it just creates more capital gains problems, on and on. And so you had some fund companies. There's kind of two types. There's the ostriches who just put their head in the sand and say, look, I'm retiring in 5 years. I don't want to deal with this. This is somebody else's problem. And then you have other forward thinkers like Dimensional that say, no, look, like we are acting with shareholders' best interest in mind. We're going to convert to ETFs. That way, they're not burdened with these massive problems. So you saw a lot of those. You saw some hedge funds convert. You saw the asset managers take a bunch of their separate accounts, pick it up, plop it into an ETF. You've seen some other use cases, but there's not that many doing the syndication, as we mentioned, for, again, a number of reasons. It's a lot of work. Herding cats would be how I describe it. You'll probably see some more this year, and we welcome them. We say, look, more people should be doing this. It's a great solution for a lot of people.
And what are the big mistakes you've seen being made, if any?
I think a lot of people, the basics is they just don't understand the rules. So they'll say, okay, here, perfect. I got 5 million NVIDIA. You say, no, we've been through this. Or they'll say, hey, they'll try to submit some tiny micro cap. And we're like, no. Again, like, dude, we don't want these warrants from some, biotech company that no one's ever heard of. But I think once people kind of get it, it's pretty smooth sailing. But I think just understanding the rules in general, but once you've read through it, once you've been through it, it's a pretty simple process. It's just new. It's still new to a lot of people, even though, we've done a bunch of them so far.
So you touched on this a little bit already, but based on your experience at Basis Northwest last week, or even just more generally, since you're so knowledgeable in this space, what are the trends that you see shaping the future of tax management for RIAs? And are there particular solutions that you expect to gain traction over the next few years?
There's various levels of tax management. We used to joke that your average advisor would come October, November, say, okay, pull up the portfolio. We got some gains. Let's sell some stuff. Let's tax loss harvest. And that was it. And then the second order level was, okay, let's do asset location. We have some assets that should go in the tax deferred accounts and some assets that'll go in the taxable accounts. And then next level is they say, maybe we'll do a systematic tax loss harvesting, almost like some of the automated services or robo advisors. And then there's the next level, and they keep going. But let me tell you an area that it's still, despite all this sophistication, hasn't really been developed. We wrote a paper, it's got to be 10, 15 years ago now, where we said, not only should there be asset location on tax exempt and taxable accounts, within your taxable account, there should be a differentiation between the goals of the investor. Are you an investor, say you're in retirement, and you want some income that you're spending? It could be through dividends, it could be through bond income, or are you an investor that wants to grow that account? Because to grow the account, you have to reinvest those dividends and income, right? It's particularly for equities. To get that 10% return, you can't go spend that 4% or 2%. Today, it's actually 1% on the S&P. Lowest it's ever been in history, by the way. It's about to cross below 1%, which is nutty. Anyway, but you don't get to go spend that dividend income. Because if you do, you don't get the 10% return of stocks. You'll get 5, right? And so I think a lot of people don't know that. But theoretically, if you were in the growing compounding phase, the last thing on the planet you want is dividend income or bond income, because you get it every year, you pay taxes, and then you reinvest. Now, this sounds crazy and obvious once you've heard it, but we wrote this paper 10, 15 years ago, and we said, you know what? Theoretically, if you could match the returns of the S&P, we're actually targeting high dividend yield strategies, but without the income, on an after-tax basis, by mathematical proof, you'll outperform the S&P over time. and in some cases, these high dividend strategies by 10, 50, 100 basis points, multiple percentage points. Now, here's the challenge. So our very first 351 launched a strategy based on this idea. The ticker is actually tax. So the strategy in the paper says we're going to target US stocks that have a slight value tilt that pay low to no dividends. So think Berkshire Hathaway. Warren Buffett has never paid a dividend. He did once like 60 years ago, and he jokes that he was in the bathroom when it happened. But they have bought back a lot of stock. And so we launched this fund, and then you say, but wait, Meb, why is this of your 20 funds? Why is this the third smallest fund you have? And I say, well, because if you think of the worst marketing angle on the planet is a low to no yielding fund, right? Investors across all stripes don't understand dividends. We did a survey recently. We paid a survey company a couple $1,000s, got thousands of responses, and said, do people understand how dividend works? And the very basic, this is like high school level investment education, 75% of individuals and a huge percentage of professionals think dividends are just free money you get paid. It's almost like an allowance or a check in the mail, and it doesn't cause the stock value to go down, and don't understand that it's a return of capital. But that explains so much in our world, why you see so many of these predatory income funds that are promising 10, 15, 20, 30% income. And that's just not how it works, and that's not how it's ever worked. So kind of pointing to there's an entire industry of people that are making their decisions based on this false premise and costing who knows how much in billions of dollars of unintentional taxes, as well as management fees, et cetera, on this concept of high income. Now, I apologize to the listeners because there's going to be a large proportion of you who this felt like telling your 8-year-old that Santa is not real. And I'm sorry if there's 8-year-olds listening to this, you guys, I'm just joking. He's obviously real. But you're hearing something that's kind of sad, but like an adult reality. And once you've learned it, you can never unsee how the entire industry focuses on this one concept. Anyway, you hit a funny bone with this topic, but I think in the coming years, you'll see a further separation within taxable on how investors approach income, no income. A good example would be our buddy Wes Gray's box ETF, which super esoteric idea, but is a fixed income fund targeting T-bills that don't pay interest. That's a $12 billion fund now. So he's a little better at marketing than I am, I think, because our fund is like 20 or 30 million. So we got to add a couple of zeros before we get to his size.
Yeah, Meb, I couldn't agree with you more. You always have clients who come in and say, hey, I need X amount of income, get me dividends. And it's like, well, you could also sell stock, and that's just a cap gain, and you're further diversified. So it just comes down to just understanding how the flows go and where you want them from. If you don't mind, tell us a little bit more about the solutions offered by Cambria and how listeners can learn more about your firm.
Sure. Well, look, we've been doing this for a long time now, and we have 20 funds. And we said in the beginning, and we still do today, we say we only launch funds that don't exist. Like, you don't need a 50th growth AI fund. Come on, there's anything our industry's good at is just throwing spaghetti at the wall. And the sad reality of our world in the public fund marketplace, ETFs and mutual funds, over the course of a decade, half close or go away. So the funds you're looking at today are not the funds, from 10 years ago. So sadly, I think over half of the portfolio managers of those funds don't invest in their own funds. And so I put all my public assets into our funds and strategies, which is a rarity these days. Anyway, so we have somewhat unique, different, non-consensus type of ideas. It ranges everything from our flagship suite of ETFs called Shareholder Yield that focus on dividends and net stock buybacks, to things like global deep value, allocation funds. We got an endowment style aggressive allocation funds. And then we start to go further afield, manage futures and tail risk. All of our funds are cheaper than the category average. A few of them are the cheapest fund in the entire category, which is cool. But we'll probably settle around this 20 range I joke with my team. I say it's one in, one out at this point. We don't need any more funds, y'all. We got enough crazy ideas, but then we keep coming up with stuff that we think is a solution. We use a lot of funds too, so often there'll be a Lego or a place that we want to say we launched a global REIT ETF because there wasn't one that existed in the way that we wanted it. So we're always open to new ideas, but it's backed by academic literature. So either we'll publish white papers or books about the topic, or rely on both practitioners and academic basis that hopefully goes back not just decades, but many, many more years as well.
Meb, to wrap up here, in a minute or less, what is the key lesson that RIAs should take away when it comes to Section 351 funds?
I think the key to all of this is taxes matter, and clients usually, and many advisors only focus on taxes when April 15th comes around and say, okay, well, how much do we owe? But if you're proactive, I think tax alpha is the easiest alpha. Many advisors could justify their entire fee based on doing a thoughtful management of taxes. And you got to think about it ahead of time. In many cases, people, only are backwards looking in the rearview mirror on how much do they owe and what do they pay. But managing these ahead of times in 351, we think is a pretty good way to think about it and get diversified and defer these to another day.
So you have a book coming out, as I mentioned earlier. It's titled Investing in America, The Rise of a 250-Year Bull Market. It's coming out on July 4th. That is not a coincidence. And we'll put a link in the notes that accompany this podcast so that our listeners can purchase it. But tell us more about the book.
I've written 5 books, edited 2 more, but it's been over a decade since I've written one. I was joking with my son, who's now 9. I said, you know how many books I wrote before you were born? And I said, 5. You know how many I've written since you've been born? And the answer was 0. I said, it's worth it. I love spending time with you, but you can take care of yourself now. You're almost 10. But this is a coffee table book, so it's different. It's beautiful. It's high quality. It's kind of a romp through the last 250 years. I mean, I think there's 60 or 70 pictures, tables, charts in this book. I don't know that many people are going to sit down and read it cover to cover, but it's fun to flip through, get it for clients. Anytime they're freaking out the next bear market, recession, crisis event, you could send it to them and say, by the way, client, it's been far worse in the past. And also, look at these times when it's been terrible, when it's been down 50, when there's been wars, pandemics, depressions, and look at the returns over 10, 20, 50 years. It's always recovered despite these problems. It's a good behavioral, I think, review of sanity and how to think about hopefully the next 250 years as well. And it's a lot of fun. We'd love to hear what you think about it, listeners. And please reach out and tell us what you think of the book. And by the way, I don't think anyone's ever published a book on July 4th, more or less on a Saturday. So pre-order it now, and you'll get it right after our 250 birthday.
Great. Well, Meb, it's great to catch up. I think you mentioned that your firm is about 20 years old. I think it's about the time you and I first met. There was a conference that no longer exists, but it was put on in Napa Valley. It was, I think they call it the Wine Country Conference, and I remember meeting you there, and that was probably close.
Let's start it back up. That was a good conference, man.
That was.
Who else serves wine during the sessions? What a great setup. We need a review of that.
Yeah. Well, listen, thank you for listening to Advisor Wars with Bob Huebscher and Joe Halpern, and today featuring our guest, Meb Faber. To learn more about Obsidian CIO and Joe's work, we'll include a link to his contact information and a link to the firm's website in the show notes. You can also find Advisor Wars on Apple Podcasts, Spotify, and YouTube, and we will include a link to connect with us on LinkedIn. Stay tuned for our next episode in our series on tax planning when we discuss direct indexing, which is the dominant solution for the mass affluent, and we'll look at the pros and cons of direct indexing. Thank you.
Obsidian CIO sponsors the podcast to further education and critical thinking about the factors that affect markets and investing. And the podcast does not provide investment advice. Investment advice is offered only to clients of Obsidian CIO who have entered into an advisory agreement and with whom Obsidian CIO has identified individual objectives, risk tolerance, and other investment needs.